Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for October 6th of 2024. Well, it's good to be back with you after a couple of weeks, and we do have some interesting new data that seems to confirm this soft landing narrative that has been out there for quite some time. You can see here, we'll start off here with the Citigroup Economic Surprise Index, and you can see that here that it's perked up above zero, so everything above zero represents a net positive surprise amongst all the economic data that's tracked by Citigroup and reported by Bloomberg here. And everything below the zero line represents kind of net negative surprises. And so, when you start to get data that's better than you expect, you tend to start revising your forward estimates to be less negative, if you will. And I think that's what's happening here, because you're looking at this line, and we're getting better, more positive economic surprises than we had. And I think, what that's telling us is that the data is getting better overall, even though there may be pockets of slowness there. And we'll look at, service sector versus manufacturing in a second. Still definitely some dynamics there, but on balance, the average set of data is getting a little bit better overall. So as a result, what we see here is the Atlanta Fed GDP Now. You've seen this quite a bit, and I like it because it tends to be fairly accurate. This is from the Atlanta Fed, of course, and you can see their estimate is captured in this green line, which does move around by virtue of the data that comes to us in real time, and where it sits right now is about 2.5% for third quarter GDP, which we're going to get the first reading of later on this month. Usually the last week of the month, we get the first reading, and then we'll get two more revisions to that before it's deemed final over the next several months. But you can see here, this blue range represents the consensus estimates that are out there, and this solid blue line represents the mean. You can see the mean estimate now is still expecting third quarter GDP on an annualized basis to fall below 2%, whereas the Fed now is at 2.5%. Now, I wouldn't get too concerned here necessarily with, the fact that this has come down from 3, but you can see that it's been in this range, 2 to 3% for quite some time. Now we'll take a look at a data point that we got last week, and that was the non-farm payrolls. And so the bottom line here is that the labor market's better than we expected it to be at this point. Now, we did see hiring intentions go down. We'll take a look at that in just a second. But overall, non-farm payrolls were much better than expected. You can see here in the actual reading, we got 254,000. The estimate here for the month of September was only for 150,000. You can see a multi-month increase in payroll gains. And you can see that this reading here is kind of consistent with some of these little bubble months that we had over the last couple of years, but obviously trending the right way. And so consequently, we see here the unemployment rate, September was 4.1. And you can see that that went down just a little bit from the interim peaks that we saw here. And obviously we had, unemployment rates that went down in post-pandemic here and kind of remained level until we started to see some increase here about a year ago. And so that seems to have reversed a little bit. So we look at non-farm payrolls over here. That was the largest increase that we've seen since March. The other chart that we don't have in here is average hourly earnings, which were up 4%, which is the strongest data point that we've seen since May. And so you've heard us talk about, for a number of months now that labor costs seem to have been moving down. And again, it's consistent with normalization of wage rates and kind of maybe a softening in the economy of sorts. But if you look at this data, and you look at the fact that average hourly earnings are not going down anymore, kind of gives you the sense that we have hit that soft landing, that we've essentially stuck it, and that also, at least from a market perspective, that good economic data translates into good stock reaction from that. Here we have some more labor data. On the left-hand side, you basically have the hiring rate in this purple line. You can see the layoff numbers down here in the black line. So those have been flat. New hires have gone down. So this is, again, symptomatic of a softening labor market. But, basically what we have here is that large companies really aren't laying anybody off, but they're really not hiring anybody either. And what you can see here on the right-hand side is who is hiring are small businesses, which small business optimism that we've seen when interest rates were high has been coming down, or have been trending down. Obviously, small businesses are much more impacted by high inflation, high interest costs than large companies are. But with the rate cut that we just had, and I think based on the data that we're looking that we looked at in the last slide with the employment report, I think what it does is it sets the table for only a quarter point rate reduction when the Fed meets again first week of next month, instead of a half point rate cut. So the fact that the news is relatively good from the labor front, and again, that's one of the Fed's dual mandates, if you will, is kind of stable employment as well as stable prices. That it's not going to be as much of a rate cut as maybe people were expecting a couple weeks ago. But bottom line here is that small business payments to hiring firms, which is one interesting indicator, is reported by Bank of America in this. You can see job openings, that's the JO, in the JOLTS figure here. You can see job openings going down, but small business payments to hiring firms seems to be kind of leveling off here and relatively stable. So, where you might see some weakness in a slowing economy, you would certainly see it in the small business sector, but we really haven't. Everything is kind of, basically, there's a hand on the rudder. We're moving forward. It's not a wildly growing economy, but it's really not in any type of meaningful contraction either. Here we have payroll growth. You can see, again, more data, two charts from B of A. You can see that is really just kind of stabilized. And I thought it was interesting to include this exhibit too, because it breaks down the geographic boundaries and looks at it on a year-over-year basis. So you can see here clearly payroll growth, like in the South, say, was much stronger last year than it is this year, but yet the South still leads the rest of the nation. And what's really interesting here, Northeast, you see profound weakness this year relative to a year ago. Midwest, much stronger. So, I guess you got to be careful sometimes. You talk about these overarching national data points. You have to be sensitive to the fact that regionally the data can be much different. Again, continuing on the payroll theme, what's interesting here, this is some Guggenheim research over here that basically 75% of job gains since 2023 have been in education, healthcare, and government. And so we do know that government interest costs is moving higher as government's having to raise more money at higher interest rates, even though some of the short-term rates are coming down. That might squeeze out some federal spending. And so if you've got hiring at the government level here, if that goes down, and if you see any material weakness in education and healthcare, the fact that we have seen some of this payroll growth this year is exciting. But if some of these areas begin to slow down, the fact that they've accounted for 3/4 of those job gains over the last 12 to 18 months, could give us a little cause for concern. Another thing that I thought was very interesting in Goldman Sachs research is that you've got the younger cohorts in the labor force that are accounting for a higher proportion of the unemployed the unemployment rate and the unemployed here in the data that we've been looking at over the last several months. Personal bankruptcy filings, you can see here something that we always pay attention to because this is a very strong, a little bit of a lagging indicator on consumption. You can see personal bankruptcies have increased here in over the matter of last couple of years. But if you go back, pre-pandemic, global financial crisis, and the tech bubble bursting, there's clearly been instances of higher bankruptcy filings than we're at right now. Now we'll transition into some of the mainstream economic data that we get on a fairly regular basis. We'll start off with the services sector, which we do know is more important than manufacturing. And we can see that the Purchasing Managers Index here for services is above 50, so that represents expansion. We can see that it has moved higher over the last several months, which is a positive here. So service sector in pretty good shape. We've got new orders within the service sector accelerating here, almost 60. And I just say as a general rule of thumb, when you start to get into 60, into this level versus just simply being above 50, which represents expansion. Obviously below 50 represents contraction, but when you're up at 60, that's a really, really strong indicator. So we're still on the service sector. You do see employment be a little bit sluggish here, so you're not seeing as much employment necessarily on the service side, but it's not in a deep contraction like it had been late last year. You've got prices paid, which even though it has witnessed a couple months worth of uptick, it's at this is a survey that is a diffusion index, and so you can see on this side, we had actual numbers that were ahead of expectations. So this did catch some eyebrows, and then PMI employment was a little bit weaker than expected. But you can see that overall prices have been kind of in a channel here. Now, if this breaks out to 65, 70, then I would be a little bit more concerned than I am right now. Now we'll look at manufacturing. We do know that manufacturing has been in a bit of a sector recession for some time. We had a little bit of a head fake earlier this year when it kind of peaked above 50 for almost a blink of an eye here, and now we've gone back into contraction mode. We did have a little bit of an uptick over the last month. You can see export orders have something to do with that. And I'd say, in many respects, we've got a very strong dollar. And so, things that we export to other countries are inherently more expensive because of a strong dollar. And that has something to do with the manufacturing side. But we, by and large, we're still kind of struggling to get out of a manufacturing funk here in this country. Now we've got employment. We do know, interestingly enough, that employment is still weak and getting weaker in the manufacturing side. A lot of that has to do with export demand, although what's really interesting, and we'll see this in another chart, is that capital spending on new manufacturing capacity is actually moving a lot higher right now, but employment is not. Some of that has to do with automation. I'm not going to necessarily say it has more to do with AI, because that's an emerging technology that I think will really begin to manifest itself only in the next, probably in the next 3 to 5 years in this data. But prices paid, you can see that inflation inputs are going down. Fortunately, we had a resolution to the very brief port strike last week, which I think will help keep these prices lower. Obviously, shipping rates and whatnot were really skyrocketing there in anticipation of a long, protracted strike, which did not happen. Manufacturing new orders were unexpectedly down. Again, this is consistent with the last chart that we showed you, and Even when you back out transportation, which could be extremely lumpy, think about airplanes, think about locomotives and things like that. It can be very lumpy. Even without that, we were down, and of course, estimates were for positive reading. We had a negative reading in both cases here. So manufacturing again remains in a bit of a funk. Here we have the dollar, which I mentioned. Dollar had over the last several months actually had weakened a little bit, and this is somewhat due to the fact that we did have a Fed rate cut, or at least the anticipation of, and then the actual cut itself. But this time series only goes back to March. If we look at it over multiple years, then you can see that that data was basically the current setup is much higher than what it was over the last couple of years. We have seen a little bit of an uptick recently, but as you'll see in a little bit, we've had a tremendous amount of easing around the world by foreign central banks, and so we, from a rate standpoint, remain on the high end. And obviously the Fed is looking at domestic data, but when you look at the rest of the world by comparison, interest rates are actually much lower around the world than they are here. So, and here is that chart, global number of rate cuts by global central banks. This is from Haver Economics, reported in Deutsche Bank's research. You can see number of rate cuts has really gone through the roof. There are still some areas of the world that are raising interest rates, but the vast majority of the world is now in an easing mode. And the question is the Fed going to be easing at the same pace as the rest of the world? And if they don't, if they're going to be a little bit more pokey, which I think seems to be the case now because the economic data is stronger than we had anticipated overall, that the dollar could continue to remain strong here. Here we have some data on construction spending, which I thought was very interesting. This is yet another data point that, despite the positive economic surprise index moving higher, that there are still pockets of unexpected weakness that haven't been fully reconciled yet. And this is one of those. Construction spending expected to be positive. Instead, we got a negative number. You can see that is the third straight month of negative data in construction spending on a monthly basis. So again, 1 month versus the next, there is some seasonality to this, but there's also the potential for it to be kind of lumpy and volatile. But when you look at trend lines, that has more informative power. We're looking at private construction spending here in dollar aggregate terms. We've got residential in the purple line, and we do know that when prices went high, we had some supply chain issues that came down and moved back up. And we're on a bit of a decline right now. And then non-res here is basically flatlined for the last several months. And when you look at residential, which is again this purple line here, and you kind of bring that down into its components, you can see that here we've got home improvements, which remain elevated relative to January 2019, which is kind of like a starting point for this whole time series. But you can also see that multifamily has rolled over, and that's very consistent with other data that we've been watching. And single family starts, which actually the starts have been relatively good, but you can see that overall data on new single family construction is down a little bit on a sequential basis. Here we have more commercial related construction. This is what I was talking about before. I mean, we have had a tremendous spike in new manufacturing and warehouse construction. This is manufacturing itself. Warehouse might be down a little bit, but it was one of the two areas when you see manufacturing construction during the pandemic went down, the hot button was warehouse and kind of in light industrial, and it just went nuts. And then eventually manufacturing caught up with it. And you can see here that this is a pretty powerful number. And it's very interesting to look at this in light of the weaker manufacturing data overall in the ISM that we've been watching for at least the last couple of years. So obviously there's an anticipation of future economic benefit to committing the dollars to this construction. I think there's a certain element of onshoring that is at play here, since free trade seems to be a four-letter word right now, and there's a mad dash to bring more manufacturing onshore. So I think that clearly has something to do with it. I think the CHIPS Act and technology spending within the semiconductor industry has something to do with this also. And then looking here at state and local government investment. And as you recall, government spending is important to the overall economy. And obviously, when economic conditions are really poor, the Keynesian way of doing things is that the government steps in and spends a lot of money to help prop up the economy. Well, you can see that government spending in structures has actually accelerated at a pretty strong clip over, I'll call it the last 18, 24 months. But that is reversing course. And so we're actually decelerating, and that's expected to go down further. Again, to my point earlier in the chart pack that, with higher interest burdens, there's going to be more of a crowding out effect on other government spending. And I think that partially is manifested here in this particular data series. Here we have private construction of offices and data centers. So this kind of pulls us back into the AI theme a little bit. And I think this is important because this is very trend setting. And you can see here that the data center growth in data center spending is not just a 1 or 2 year phenomenon. It's been going on for quite a while, but it's really accelerated, relatively speaking, over the last year and a half. And you can see that very clearly defined here. At the same time, you see office construction go down for obvious reasons. I'd say not that it ever really accelerated, but it was just at an elevated level, and obviously with increased vacancy rates and the rationalization of workforce in the office to some degree, even though it seems like we're moving back into the office. You've got a lot of companies that are wanting people to come back in 5 days a week or whatever, and kind of seeing a backlash, but it's still not enough to turn this around, even though right now it looks like it's just flatlining for a couple of months. But it will be interesting to watch. I think there's still a fair amount of office absorption, so I feel like this data series is going to be weak for a while, at the same time that data center growth is going to continue to accelerate to some degree. This slide represents property prices. So we're still talking about the commercial real estate sector. Not too surprisingly, in the pink line you see offices. That market remains very subdued for a lot of the obvious reasons. We see conversely on the apartment side, which, as you remember, anything multifamily represents a commercial investment, and so. This is a very interesting development we've seen over a period of several months, moving higher. And what happened here is we had basically a lot of spending on apartments. Banks were very willing for quite some time to lend on apartment construction, and so they did that. And so we flooded the market with apartments. We could see observed rents in those rental markets going down. And as a result, we saw an associated decrease in property values as those cap rates changed, even amidst higher interest rates. And we could see that those cap rates went higher and the values went lower, but now that seems to be reversing itself to some degree. And at least what it's doing on when you think about like the broader commercial property market, at least it's kind of attenuating those consistent declines, and in fact beginning to cause the commercial property market to uptick a little bit. And of course, this has perhaps positive implications for real estate investment trusts. It has implications for developers and development and the incentive to take down funds. If you have a rising price environment, that tends to bode well for risk taking in the real estate sector. So we'll just have to wait and see. Now we are going to talk about the equity markets a little bit. We're going to start off here. We've got liquidity at a real high point. This is, I'll call it like, the G10. So this is a global liquidity measure here, not just necessarily U.S. And this particular series is pushed forward about 6 months, so that's why it looks like it's falling into 2025. But it is a leading indicator when you talk about the overall health of the investment markets, which is really the theme today. It's like, well, valuations are high, but we sure do have a lot of liquidity there that I think will help to support equity valuations, even though those valuations are higher. And so that's what's being captured here, that we've got a lot of liquidity in the market. Now, sliding over here, we've got basically the S&P 500 total return index is now trading at a price earnings multiple of about 21.5 here. And so this is intended to plot just, you hear the naysayers talk about like future expected returns being relatively muted. Well, that would certainly be indicated by this line of best fit, which is the orange line here, that, a multiple this high would tend to lend itself to probably about a 5% annualized return looking out over the next 5 years. But, with all of these data points here, and I believe if I had to guess, I'd say there's probably data that's going back to, at least 20-25 years that this correlation is not very strong. And so I'm not saying that this isn't right. I think it's informative in the sense that we should be looking for other ways to get return in the market and not just relying necessarily on just stocks, or I think it's going to be a mix of alternatives and maybe structured investments and things like that. But there is an awful lot of liquidity in the market, despite the fact that these valuations do seem a little bit high. So here's another interesting set of data related more towards fixed income that, this is an update to a chart that I showed probably a couple months ago. And it's just, there's a tremendous amount of interest on the part of private clients to add to treasuries. And again, with the expectation that we're going to have lower interest rates, and that lower interest rates are going to raise prices because there's an inverse relationship between yields and prices. And so you can still see that the private clients are still adding to treasuries, even though you're looking at T-bills, that enthusiasm has gone down because those rates are obviously moving in the downward direction. In the 2 to 10 year category, you see a lot of enthusiasm, and that enthusiasm has persisted for quite some time. And the other thing going on with treasuries, which is very interesting, is that you've got a tremendous amount of foreign investment. And you can see here in this chart from Truist that the demand from foreign sources set a new record in September. And you can see that this whole shaded area here represents foreign investors. And so obviously our rates have been higher than the rest of the world. So, there's more demand from that standpoint. But what this does and this does, you've got more domestic demand in treasuries, particularly in the 2 to 10 years category, and these are 2 to 30 years. You got more demand here, more demand here. What that's doing is pushing prices up, and then it's going to keep a lid on overall yields over the near term. So we'll shift our attention now to the equity markets again, and you can see here that we've got valuations by different size cohorts. So this is the overall S&P 500. You can see, as we talked about, the valuations are about 21.5 times earnings, and this is based on forward earnings. And you can see the average is around 16. We've talked about that a lot. So there is a delta here that might argue that stocks overall are too richly valued. And you can see here on an equal weight basis, again, the average is about 15.5, 16. The equal weight, we've seen a little bit better breadth in the market. And so, when I showed you this chart from Truist about 3 months ago, that was a lot closer to 15.5, but now it's 17.2. Again, multiple expansion in addition to earnings. And you talk about mid cap, then you're much more in line. And then when you talk about small cap, you're actually at a value deficit relative to the long-term 20-year average. And so, this argues for small cap investment. The big question is, are you going to have a catalyst? But as we saw earlier, with interest rates coming down gradually, it does help small caps when you have kind of an end or, end of a tightening cycle from a financial institution standpoint. And we're going to look at private capital here in a second, and also business development companies. I mean, those guys are still lending. So it does set up pretty well for small caps. Here we have on this chart with the percentage of sectors that have a quartile PE ratio. This just means that the percent of overall sectors that are in the top 25, 25th percentile of valuation. So you just, again, this is more breadth in the market. It's not just technology, but you've got broader participation, which is resulting in this number moving a little bit higher. So here's something else to consider too. So we've already talked about there being a lot of liquidity in the market, which is good. We've talked about valuations being high, but here's the other thing. When you talk about price to earnings, and we clearly have seen that there's been multiple expansion. Well, guess what? We've also had margin expansion on the part of not only U.S. companies here, but in the global ex-U.S. realm as well. And those margins are translating into profits, and we're watching profit growth as well. And so this is kind of setting up to be, I don't want to get too carried away and call it like a Goldilocks scenario, but when you have liquidity in the market and you have strong margin and profit growth, that really does set up well for equities. And if not for the higher valuations, which I think could create some volatility, and mind you, we're going to get, we are just on the front end. I think, believe it, next week we're going to start hearing some of these third quarter earnings releases on the part of publicly traded firms. But the fact that we've got strong profits setting up at the same time that we've got liquidity in the market, and we have this kind of burgeoning, soft landing narrative out there, it does help to create a positive case for equities here. And something else I mentioned earlier that is really helping to drive, I think, potential value creation in the small cap sector particularly is we've got business development companies, BDCs. You can see that bond issuance here is going nuts, and that means that they're obviously raising a lot of money to lend to middle market companies. Small and middle market companies in the U.S. So, and this is high grade too. This is junk. This is not necessarily high yield, although it's much higher yielding than some other, kind of corporate AAA paper. But you can see that issuance is going nuts. And also you've had a lot of interest in the debt markets as interest rates are moving a little bit lower. And you can see that number manifested here. So we have a lot of risk taking. We've got a lot of lending going on, even though aggregate lending rates versus a couple of years ago are much higher than they were, but there's a much higher degree of optimism. Something else that really helps investors in this environment is the fact that, even though we've seen default rates move a little bit higher, and so this is obviously something that we want to be concerned with. But the spreads on that type of paper, lending to credit-worthy customers, I guess, if you will. If you expected there to be an erosion of credit or even though you're seeing this, if you expected these default rates to continue to move higher, you would in no way see credit spreads that are this tight right now. It's just very unusual to see this. Now, what's the solution? Where does this end up? I think it's tough to say right now, but if we are truly on the eve of a new expansion, then eventually this is going to roll over. This might move higher before it moves back lower, but it may not move materially higher than it is right now. Quick check-in on the energy sector. This chart, despite the geopolitical tension between Israel, Iran, and the whole tinderbox that is the Middle East, we've seen a decrease in NYMEX gasoline futures. That's not to say that crude isn't being impacted, but generally crude and gasoline will move in the same direction at maybe a little bit of a lag. But we see here that NYMEX gasoline futures moving down, and retail gasoline average prices about $3.20 a gallon across the country, and likely to perhaps move a little bit lower. Again, we're transitioning well away from the peak driving season here and getting into the heart of the fall here. What's interesting here, and this really isn't anything informative per se as far as investment markets go, but where you've seen a significant decline in coal-fired power generation, you've seen that be replaced by natural gas. Now, those of you who follow the power markets are not going to be shocked at all by this, but what's interesting, and the reason I put it in here, is that there's much more discussion now of a nuclear powered generation, and you can see that that's been flat for quite some time. But I think as we look ahead, there could be some policy shifts, and again, the need for power for data centers, and we just saw how data center construction is moving considerably higher, that I think there's going to be a demand for more nuclear, and this line is eventually going to tail up over a period of maybe the next decade. And the last chart I have here is median valuations for venture cap deals, and got this broken out by Deutsche Bank between non-AI, which would be in the dark blue, and then AI-related companies. And we have seen considerable interest on the part of venture cap firms. Series A is, this is post-revenue. Seed capital is just for pre-revenue companies that have great ideas and probably very experienced management teams. They just have a track record, but those valuations are higher. And you can see as you go from Series A, which is a little bit more mature. Series B is kind of that last, probably, step or two before you might go public. And those valuations are very, very high right now. That's all we've got in the chart pack this week. Hope you have a great week, and we'll talk to you again soon. Take care. Bye.